All right, good morning. Good morning. Today is Thursday, July 23rd, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as our different social media pages. If you are with us live or if you are watching in the recording, we appreciate you taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team, Ann Colian, Josh Denny, and Karen Miller. Together, we help successful families identify the risks they don't see, protect what matters most, and align every resource they have with the life they want to live. It all starts with an understanding that our clients are at the center of everything that we do. We come alongside them as their financial director, and we look for two things: opportunities and potential train wrecks. We look for opportunities and risks in the areas of their investments, taxes, estate planning, insurance, titling and beneficiaries, Social Security, and much more. If you're hearing this for the first time, if we've never had this conversation, then I invite you to schedule a face-to-face conversation on our website, which of course is www.investwithccg.com. Today, we're going to learn more about the risks and opportunities in the economy and the markets as we hear from our guest speaker, Tom Fox. Tom is a chief investment strategist with Water Street Research Partners, and as always, I'm very excited to have him here with us today. Tom spends all of his time more behind the scenes, doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has almost 40 years experience building investment strategies. He has a long, impressive resume, as you can see here on the screen, and we are all very, very fortunate to have him with us here today. So like I said, Tom today will review the positives in the markets, the headwinds, and give us his outlook moving forward. Now, ultimately, this is your opportunity to kind of look over our shoulder and get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions, do not hesitate to ask, and I'll review them at the end during a live Q&A time. You're welcome to submit your question during the presentation as you think of it. I'll bring it to Tom at the end. You can text me at our office number on the screen. You can also email me. My email is on the screen as well. You can also post it in the comments section if you're watching on our social media pages. If you're on our website, you can also ask more anonymously using the button below this video live stream. And then lastly, if you're watching in the recording, we would still love to answer any questions that you have. And you can use any of these methods to submit your question. And we would, again, love the opportunity to circle back with you. So with that, I will bring our theme for 2026 up on the screen. And we're having a little bit of technical difficulties, but I'm going to bring Tom on, and we are limited to audio today. So we're not going to see Tom's handsome face, but I think Tom is with us. Tom, can you hear us?
I can hear you.
Wonderful. Good morning. We're sorry we don't have your video today, but we're glad that you're here. So thank you.
Well, I'm glad I'm here too. Hello, everybody.
So welcome. So our theme for 2026, things have changed. We're seeing some more changes here this morning. I'll bring up our outlook.
Okay, here we go. The theme, things have changed. And of course, AI is the big catalyst behind they have changed. And also, we have an Iran war going on. And it's sort of this battle between AI and oil that's driving the markets. But I always like to start off with why we should be worried. And I think that one of the big ones, of course, is the inflation risks remain. It's moderated some from its peak, of course, but it's been edging up, except for this last month. We'll talk more about that. Of course, that impacts energy prices and so on. And so it can be disruptive, if especially the Fed, which we'll get next, of the uncertainty, because the Fed has got to look through all this complex information. The war in Iran, is it transitional or not? So that there's a potential that they could raise rates. Now, they didn't, of course, in their last meeting, and they're not giving out any kind of hints whether they will or won't. Under Kevin Warsh, it's kind of more keeping it in-house until they're ready to disclose it. So inflation's been sticky. It hasn't gotten to the 2% of the Fed's target, and we'll see where it goes from here. And of course, a lot of it right now, I think it was going to get there except for the Iran war. And that seems to even be heating up more. So there's another thing, there's been elevated uncertainty in the market valuations. It's elevated. AR leaders are still, have a very high PE ratios, or price for near perfection. So anything that disappoints in the AI area could cause the stocks to come down swiftly. And we've seen a lot of volatility recently. You remember in our first of the year, I forecasted we would have extreme volatility, and that has been occurring, and it's still occurring. So the geopolitical risk still elevated. It's becoming even higher now with, I just read that President Trump is moving more military assets. The special forces have arrived in the region, and they're even bringing medics. That's a sign that this is going to escalate fast. And so how long that takes or how it all ends up, nobody knows. But it certainly has been driving up oil prices. Energy markets remain vulnerable. And you can see the oil prices gone up recently with this new episode in the Iran war. And I think we reached $100 a barrel. We were down at 79, 78. It's been in the 80s, kind of going sideways. So we've had a bump up. The Houthis are now trying to block the other travel way for containers of oil. So this is kind of expanding right now. It's going to be interesting to see how it all unfolds, and we're carefully watching it. If it gets resolved, we believe this market will take off very fast. So it's hard to predict or forecast, but we think it will end, and you'll see that at the end, our final comments. And of course, this is a longer term thing, is the growing fiscal deficits, but it does impact the debt and the yields on treasuries. And so as long as that they have to buy or sell that many or that level of treasuries, it's going to keep the rates higher than normal. So that is something, but that's a long-term one. It's not going to really impact anything today, but it's in the future. So that needs to be dealt with. And of course, we have consumer resilience has been phenomenal. But what happens if it weakens? If it weakens, because the high borrowing costs, job growth, record debt levels, it could impact consumer spending. And as I've said many times, it's over 70% of the US economy is consumer spending. This needs to stay intact. It has so far. It doesn't, according to the credit cards, the major banks have said they have not seen a slowdown in spending. So people are still spending out there. And of course, profits expectation, earnings growth and has been exceptional, but could we see a pullback on this? That would be a risk. We're watching that very closely. And of course, we're 4 years into this bull market. So we're late cycle. And historically, there could be some mistakes. It could pull back. It's like a beginning of a bull market, but it's seemingly we're towards the latter innings of this bull market. And then, of course, investor optimism has been very high. I put out a piece that margin debt has grown to a level with all the excitement in AI that is beyond most of history, and it's above the average And normally when you see this kind of margin debt, you'll see also a pullback, consolidation, not necessarily a bear market, but a consolidation, and then it begins to move back up. So we're watching that carefully. And we saw recently Korea, one of the best performing stock markets, suddenly went the other way and came down significantly in their stock market. They went from the best. Now I don't know where they overall land, but they've come down really hard. And there's been tremendous margin calls on that particular, all the individuals that invest. A lot of retail people in Korea have money, and they say up to 1/5 of the people that were invested now have margin calls. It's a huge, staggering amount of margin calls. And so if you get margin calls, then it puts more pressure on the downside. But that's happened in Korea. And we are still tipping at a very high level. So those are all things we need to watch for. And of course, as we go forth, we got unexpected policy changes. We don't know if the Fed's going to raise rates, lower rates, going to be more tariffs. And so all these heighten volatility potential. So those are the worry. We're watching them very careful.
Yeah, there's a lot of them. So appreciate watching like you do. Let's get some positives up there, though, because there's a lot of them, too.
Should we end the presentation?
No, we don't want to leave everybody hanging with one half of the story.
It's only one half. But there are many reasons why to own stocks today. Earnings support, valuations. This is phenomenal. Last quarter, we had spectacular earnings. And it appears that this quarter, we're going to have spectacular earnings. We'll look at some charts on that. And it justifies higher valuations. Because remember, the price to earnings ratio is a valuation measure, and the E is the earnings. And if earnings keep going up at over 20%, then you could have prices and stocks go up, yet the valuation doesn't go up. And that's what we've been seeing. It's kind of holding where it is. We're having a little downturn now, so even get a little less expensive. So earnings have been just spectacular. Cash flow. It's just been a phenomenal corporate time. And so we think that's very bullish. We don't think it's going to stop at this point. We think it's going to keep going, and we'll see how this particular quarter ends up. But the initial numbers, which we'll look at, are phenomenal. And then we have this resilient U.S. economy. Consumer spending is strong. Employment hasn't come down. It's strong. Capital investment is at a record. Business activity continues to demonstrate remarkable strength. And so the economy and what's going on in the earnings is still broadening. So we have also broadening market leadership. We'll look at a chart where it shows that the technology sector, which has been leading all year, has recently underperformed the other sectors, and they're picking up the steam. There's many industrial, healthcare, financials that are doing really well recently. So they were underperforming, and now they're coming back. That is all really good for extending a bull market. So it's a very healthy indicator that things will probably keep going. And then we have the AI and infrastructure super cycles. Some of the Mag 7 reported they're spending more on the infrastructure for AI. So it's record investment, power generation, electrical equipment, cooling, networking, and semiconductors. Really, they should support all of this capital spending, and so we're that money's people have to build these things, so that's good for the economy, and they're doing record amounts. And then we have really the companies are healthy corporate fundamentals, and that kind of goes back to the pandemic where companies got lean and mean, and they've kept it that way. So any revenue that increases, earnings just go up. So we have very healthy corporate fundamentals. that are going on. Cash flows, allocations have been disciplined. So it's really been a good, solid corporate time to be in stocks. And then we have the United States remains the world's innovation leader. Of course, Trump's bringing people in. Different countries are investing more and more in the U.S. That produces jobs. That produces wealth in the U.S. That's very positive. We're the go-to right now. And then there still is, amazingly, Eric, there's still a lot of cash on the sidelines, trillions. And so if that money decides that the stock market is going to go up, they get more secure. If the Iran war gets settled out, you could see that money come in. So there's a lot of gunpowder on the sides. This is another reason to own stocks. There's a lot of potential catalysts for this stock market to go up. And innovation remains a powerful tool. We are inventing robots and automation, advances in AI, biotech. I believe, in which we talked about last month, that we're in a super cycle for that AI is going to change everything. Of course, it has its dangerous sides too. We saw Anthropic recently had a rogue AI break out of its containment and try to hack into a company. So there are risks to it, but I think they'll get those under control as we move forward. But I use AI a lot. It's been an incredible tool to aid my research and things like that. And then capital spending cycle is accelerating. Business, investments, all this manufacturing, infrastructure, it's all growing very fast. All good for the market.
Excellent. Long list of worries, long list of positives. Ultimately,
so
bull market is
flip a coin,
intact.
Eric. Flip a coin. No, I think
Could flip
until
a coin, but ultimately the bull market is still intact.
it is.
Right?
That's why.
Yeah.
That's what. But look at the bottom line: volatility increasing, but it's still intact.
Might not feel like
We
it's
don't
intact,
see
but it is.
reasons to exit right now. So, but put your seatbelt on, because we're going to have, which I said at the very beginning of the year, we're going to have extreme volatility, and we're experiencing that right now.
Right.
How is this bull market done? Driven by earnings? Well, you can see the green line at the very top is the best performing, and you can see the top decile, top quartile, and so on. You can see the median in the middle. So this has been it broke out. This is a very strong bull market, pulling back right now, kind of heading towards that top decile as we speak. But we think that it has room to continue, and I think AI is probably the big catalyst behind that. Here's earnings forecasts. This is interesting. If you look at the circled one, it's the S&P 500 in total. And the blue bar is what it was at the end of last year, December 31st, forecast. And look at where it is today. It's up substantially. The growth forecast continues to rise. And you can see it's driven by energy because of the Iran war and technology. All right, here's a snapshot. We've had only 14% of the S&P 500 report, but you can see that it's 93% are beating analyst expectation, and it's huge surprise. What's the percent are they beating? 15.9. Those are spectacular numbers. They're going to probably come down some as we head through this quarter. A lot of the earnings and revenues will be coming out next week. We've got I think over 170 companies reporting. That will be a big determination is next week. But you can see so far it's been spectacular. And here's the broadening out of the market, sector rotation. We can see that the best performing was the financials, healthcare, utilities, real estate, industrials, consumer staples, and energy. Then you can see the big winner at the bottom: technology, information technology, communication services, consumer discretionary. Those came down. And so what this tells us is that this broadening out, there's sort of an ebb and flow. I also believe it's going to invert coming up over the next several months. And then the information technology will be back on the top. But this is a good sign. We're seeing positive returns in other types of stocks. That, again, as I said earlier, that normally means this bull market has potential to extend much further. Now, this is an interesting chart. Now, of course, we just had this is the futures outlook for oil pricing. You can see the peak. This is when the conflict started. That was the forecast for the future. And then you can see what it is currently. And the post memorandum, that was when they had the peace deal. It looked like there could be a settlement. That was the future. But look, you can see the futures are saying we're going to be well below we're going to be below this in the lower 70s as we move forward in the future. So the expectation, even though all this geopolitical risk is out there, is that it's temporary. Here's another positive. We're seeing tremendous M&A activity. That normally is a sign that we're seeing that we're in a bull market. You can see the blue dots. That's the number of deals that's been accelerating. You can see the red arrow going upward, and you can see the billions, the debt value, deal value, excuse me, that's going on. We're heading north. So there's a lot of M&A. That means corporate CEOs are positive on the market. Okay, what about valuations and forward PE? This is showing the Shiller PE ratio versus the forward earnings PE ratio. And the difference is that Shiller looks backwards 10 years and then normalizes the numbers. So it's a backward looking PE ratio, and it's very high. It's almost approaching the tech bubble. But if you look at the forward earnings, because of their great, stellar, spectacular earnings, it's only at 21.1, and that's come down recently. So the forward earnings are doing well. Why? Because earnings are blowing out. They're spectacular, keeping that PE ratio by looking forward. And you could look, the Shiller is more of a long-term view, but the forward today is the most important one, and it's still hanging in there and not going up to new highs. AI is still in the early innings. We'll see that. This is the technology earnings continue to drive the market, the revenue growth and on the left, and then we have earnings growth on the right. And you can see that tech and energy are driving both of these substantially more than all the other companies. And we have a weighting in both tech and a lot of it kind of tilted towards AI. There's a reason for that, because that's where the big earnings growth is. Now here, this kind of gives you a picture. It's powerful. That the growth theme hasn't changed, but you can see the volatility in the right side of that chart. And that's come down even a little up and then a little more down. So we're seeing a lot of volatility right now. And really it's driven mainly by the Iran war, the uncertainty around the Iran war. But this is showing that there's been a lot of volatility. I was looking, Eric, at a chart of Cisco back in the tech bubble, and it followed kind of this pattern, and it came down like this, and then it went to new highs. And people thought that was the end. Well, it came back down quite a bit and went to another new high. And they don't have Cisco did not have the earnings or the revenue growth that we're seeing today in AI. So I think this is healthy. In my view, we're getting close to a buying opportunity. It could come anytime. We'll see. But right now, we got to see what happens with the Iran war. But I think we could definitely go to new highs.
Right now, the Iran war news seems to be impacting NASDAQ's down about 2% as we speak.
Yeah, it is. And that's because we're sending more assets. Medics, if they send medics, that means there's going to be some close encounters.
Right.
This is an interesting chart. It's a cycle composite. It's a technical cycle composite. And it's pointing to a tech turnaround from recent declines. And if you look when that swoops up, like we're currently, you can see that the stock market tends to go up. When you see that upward move, tends to go up. It's not a perfect cycle, but it does have, it's been pretty good at showing that this could be a turnaround in the tech. So again, we think buying the dips is still a good idea. And we think that tech and AI will go to new highs. Here's memory. Margins are skyrocketing. You can see the forecast going forward. This is AI play. And you can see where it's been. It was, hovering around 10 to 20%. And then now look where it's at. Huge margins. They're becoming, right now there's a high demand. There's a shortage of memory. They're selling out. And so memory stocks are a good place to be. Now, this is the expectation for the hyperscalers versus the semiconductors. This is free cash flow. And one of the reasons the hyperscalers cash flow will head down and maybe even become negative, we'll see. But it's because of the amount of money they're spending. And we just had a Tesla and Google just came out, and they're going to be spending more on their build out of AI, more than expected. But the semiconductors cash flow is rising. So there's a big difference between the two. We have a lot of semiconductors in the portfolio, so we're excited about this. This is new because Oracle, Microsoft, Meta, Google, Amazon, and so forth haven't issued debt, but they're issuing debt for this big build out in AI. Now, currently, when they announced it at the earnings narrative, they said that they're going to spend more than they expected. So this may even go higher. So there's positives and negatives. One is cash flow, which we saw. That's a negative. But the other positive is these companies are tremendous cash flow monsters. And the debt there, even though it's very high, they're able to do this because had almost zero debt. Some of them had zero debt. So this is sort of a new phenomena, but we're going to keep an eye on this, especially for those names that are listed. All right, this is an indicator of the economy. Philly Fed Biz outlook, well above expectations. It's its highest level in 5 years. This is indication of manufacturing in the U.S. So this is a good sign that manufacturing is heating up in the U.S. And it means that they're undergirding this is the economy remains resilient. All right, here's some good news on inflation. Fed holds rates, markets continue to price an additional tightening. You can see this is a long-term chart. of headline CPI, but you can see where the circle is. This last month, it's headed down. This was a big surprise. It decreased by 0.4% in June. That was very interesting. We'll see where it goes from here, but that was good news on the inflation front that it's starting to head down. We'll see what happens, but now just recently we've had a spike in oil again. So we'll see how this works out. But that was a good sign that inflation may be heading down. We got some more charts on this. You can see this is the wage growth. How much are companies spending for wages? And you can see the red arrow, it's been coming down. The median wage, you can see, but the other wage, which is the headline CPI inflation, everything's coming down. And so you can see CPI kind of came up, but wages are not driving the inflation. In fact, they're deflating. This is a good sign. And it points really that the Fed may not have to raise rates. It's probably going to be unlikely. That's our stance. We don't think the Fed will raise rates. I think they're going to hold and kind of wait and see. This is an interesting chart. If you look at the 50-year average, 32%, this is the number of, there's a lot of components in the CPI. This is the number of components that are going deflating. You can see the average is usually 32%, but we're up to 49% right now, deflating. And you can see that even in the other lower right chart, that it's coming down. The CPI is starting to come down. And so we hope this continues. But this is an interesting chart that we're well above the historic average of deflating components. So it's really in a couple areas, a few areas that inflation's going up. Housing, by the way, is coming down. Housing inflation is coming down. We're seeing a lot more deflating. So this is good news. If the Iran war can be resolved, I think many components are going to deflate from where they are. Now, this is the Fed remains on hold. You can see where they are. We're at the 350 to 375. The non-voting don't really matter because they can't vote. But you can see the vast majority is in that 350, 375 of voting. So they did hold. So it just means that the Fed is not moving those blue circles upward. That's good news, because that would slow down the economy and could create a consumer situation. Now, what does the market think? This is interesting because the Fed seems more we're not going to raise rates. But if you look at the market, it thinks we are 1.5 potentially is where we are right now. You can see at the beginning of January, we're expecting at January of this year, we're expecting 2 cuts. You can see what the market thinks versus the Fed. They seem to be in different areas. So it's sort of a tug of war. I don't think the Fed's going to raise rates. I think the market needs to, its forecast for rate hikes needs to come down. Here's a warning sign. This is what we talked about, margin debt. And you can see that when you get up above that line, that red line, that there tends to be, except for there was one that didn't. The last one did not consolidate, just a little bit. And so this tells me that we could have a pullback, which we've been forecasting. We've been forecasting that for a long time, that we could see a pullback, and this margin debt level could drive it. But it's not a consolidation. Then it goes to new highs historically. So we're not concerned about it, but it's something that we're watching very carefully. But we could see margin calls here in the US like Korea. Probably not like Korea, but because they're a very narrow market. Ours is much broader.
I know in a lot of my discussions with people, the word pullback can be concerning. Can you expand on what you mean by that?
I do not see a bear market of 20+%, but we could have a correction. And Eric, on average, the normal intra-year pullback on average for this S&P 500 is over 14%. That's a correction. Corrections are very normal. They don't last long. They come in and out fast. It's hard to time anything like that. The only thing you could do is use this for investing more money when it does pull back. But I don't see anything more than maybe up to 15% or less. And I do not see a bear market. I do not see a recession at this point, but we're watching it every day. And we will make it. What we try to do, Eric, is avoid bear markets, 20+%. Take something off the table. Not necessarily for corrections, because there's many of those. Every year they have one, and then you can go to new highs. So really, we're bear market avoiding. Try to avoid bear markets, but we'll ride out the correction because they're very short term.
Excellent. Thank you for that.
All right, this is kind of off everything, but which of the 8 LLMs or AI programs predicted the World Cup winner? Do you have any guesses?
Oh, sorry, I jumped ahead.
Claude.
All right, I just revealed it all. Yeah.
Yeah, Claude got it perfect. All 8 side by side. You can see ChatGPT was second, and then so on. And it goes all the way down to all the large language models, AI models, but Claude was the best. For all you World Cup fans,
Right.
You could have made a lot of money. All right, we have no changes. So let's recap them. This is our year-end forecast. Extreme volatility. We've had that in from the beginning, but both ways, Eric. Not just downward volatility, but upward as well. So if you miss a couple days, you could miss a huge run. Economy slows but stays resilient. They keep spending. No, we don't see a recession. We do still believe the war in Iran is going to come to an end. Maybe it's being extended right now because of the new changes that they're making. I think they're going to finish it because the current regime is not going to deal with the U.S. They're going to still try to attempt to build a nuclear bomb. And if they have a nuclear bomb, they could shut down the Strait of Hormuz any minute. That would be very scary for Israel. They would be at a close to extinction at any moment if they had a nuclear bomb, because it's a small country. One nuke could take out pretty much all of them, all of Israel. All right, so we're bullish on stocks. We see pullbacks and weakness as buying opportunity, like we're getting closer to one right now. And here's the catalyst. Policy support is very positive. We got spectacular earnings, and then that's going to continue because the AI-driven productivity gains, and that's going to spread out across all stocks. AI stocks continue to lead. High-quality technology will continue to dominate. Right now, they're pulling back more than the general market this month, but we expect that to turn around in the coming months. And then stocks, we're still holding to a 10 to 15 this is the S&P 500, 10 to 15% return. We've been right around that 11 to 9% so far. We've been kind of hovering around that. But we could exceed our forecast if this Iran war gets resolved. We could see the forecast even go higher. But right now, 10 to 15. I think I had that at the beginning of the year. We haven't changed that. And of course, I had my list of wild cards in the gold, but 3 of them hit. We've got Middle East escalation, we've got global shipping disruptions, and commodity energy prices. So actually, that was interesting that 3 of our wild cards have hit. Yeah, and those 3 have really have kept this stock market, even though it's up quite a bit for the year, have kept it from really roaring. If we didn't have the Iran war, we would be probably at record levels.
And we might not be really roaring, but 3, as you said, 3 of your wild card things have happened, and the markets are still up nicely for the year.
It's pretty amazing.
It is amazing. Well, thank you, Tom. We always appreciate the balanced approach and balanced view that you bring us on these monthly updates. Long list of worries, long list of positives, and appreciate you paying attention to this for us. So with that, I'm going to open up to any questions. So if anybody has any questions, if you're watching with us live, I do see a bunch of you out there, so thank you for being here. You are invited to text us, email me. You can submit it on our website below this video. However you feel most comfortable. If you're watching in the recording, please don't hesitate. Again, we'd love the opportunity to circle back with you. Not too long, hopefully this afternoon, I should have a summary of today's presentation for you. I've got that put together here, and we'll get that posted on the website. It's a great tool to kind of refer to, the cliff notes, if you will. Plus, it can come in handy if you're out with your friends and talking about the economy or the markets. You can show them how smart you are. So, great tool to have around. Obviously, as always, this message has been recorded. Recording will stay on the website and different social media pages. And I will be putting a link to that summary as well here, like I said, as soon as possible. So you'll be able to go to the website and get that for yourself. We do this monthly update every month, and the next one is scheduled, kind of penciled in for Thursday, August 20th. Again, that'll be 11 a.m. Central Time. We will be virtual again as we are today. So you can mark the calendar. And then last reminder, if you want to know what's happening in the markets and the economy kind of in between these monthly updates, I do start my week each Monday, 9 a.m. Central Time, with a short 3 to 5 minute update, kind of summarizing what's going on in the previous week, some things that we're watching for in the week ahead. Just like we are today, I broadcasted on our website and our different social media pages. So if you're not following us or connected with me on different social media pages, I invite you to go and do that, and you'll get that notification when I go live. And then later on in the afternoon, usually about 2 p.m. Central Time, I do send out an email kind of linking back to that recording. So if you'd like to get that email so you can watch it later on in your day, go to the website. You can subscribe, of course, right there. Just checking the email here. I don't see any questions that came in. The text, I do not see any questions at this time. So one other reminder, and I'll give you 1 more minute here to submit a question if you have it, for those of you on the call. One other last kind of fun thing, registration is open for our annual Capital Cruise Client Appreciation Dinner. It's a mouthful. Love to have you out. If you are an existing client, you should have received an invitation in your mailbox, your snail mail mailbox, sometime in the past few days, maybe the past week here. Registration is open. Give us a call, go to the website, RSVP. Registration is open. It is set for Thursday evening, August 27th. We will again be on Lake Minnetonka, my favorite lake, I think arguably the best lake, on the best boat. So biggest boat on Lake Minnetonka, Allen Alamos Bella Vista. We've had that the last few years. It works out just fantastic. A wonderful night. Hope that you guys can join us. We really look forward to this every single year. So with that, I'll glance, see if we have any questions that came in. I don't see anything else, Tom. Tom, do you want to add anything else, or otherwise I can wrap us up?
Well, I look forward to the Lake Minnetonka boat ride every year. It's one of my big highlights of the year, and also be able to see and talk to all the people, the clients that you have. And so very excited about that. And then regarding the market, expect volatility. We're kind of heading into a new realm of Iran war, and we'll see how this thing shakes out. But that if it begins to get worse, you're going to see a lot of volatility in the stock market. I would look at talk to Eric about maybe putting some cash to work if we do get a greater pullback.
It's a great reminder. That's something that I do personally with each of my clients. Dan, if you're a client of Dan Oshman's or Ronna Grant's or Jeff Halverson's, that's a one-on-one discussion with each of your advisor on the timing of that, if it's appropriate for you. Again, we start with our clients' goals before we do anything with the investments. So we want to make sure that's all in alignment. So if you're interested in having that discussion, please reach out to myself or to your advisor, and would love to have that conversation with you, of course. So, well, great, Tom. As always, we appreciate you a lot. I know a lot of work goes into these monthly updates, and small representation of the amount of time and effort that you put into watching everything for us. So we appreciate you very much.
Thank
Thank
Eric.
you.
Thank you so
And
much.
with that, that concludes this month's update. So thank you all that joined us live. If you're watching the recording, thank you as well. We appreciate your attention. And I will wrap us up. So everybody have a wonderful rest of your week, and I hope to see you on the cruise in just over a month here. Bye, everybody.
Bye-bye.